Well, hello, ladies and gentlemen, and welcome back. 100 plus years of data. Today, we discuss the correlation matrices with 95-day bull runs. So far, we've seen a bit of a pickup in markets. Will it sustain? We also want to talk about unfilled gap zones. In the Monday session, we hit into an area that we thought would occur. We've also seen a rejection that's like a shooting star. We've got some amazing levels to discuss, and we've got all the hottest charts for stocks, commodities, and cryptos moving forward. Let's get into it, guys. Well, welcome back, everyone, to the Daily Show. We'll be going through the macro, the news, the lead indicators, and of course, the hottest charts for you today. But let's begin by discussing 100 years of bull data. Now, we want to talk about the idea of 95 days after a bottom and whether we're in a high correlation with a return. So if you look at all of these dates where we got these signals, the stats are relatively good. As of this week, we basically see 2 weeks later, maybe some fizzling. And then after that, it generally is pretty bullish. 73% of the time, 12 months later, markets are up. Now, of course, this time could be totally different. We just want to show these stats so you can see them on the charts and see some of these correlation matrices. Here are some of the other periods. Notice some of the things happening in the 1930s, both really big bull sides and really bad bear sides. I also think one of the big correlations here that's really important to note is the 1970s and 80s. If you look at the 70s reads and the 80s reads, you'll notice that yes, the market went up a little bit more, but overall, it was kind of like the beginning of still bad stuff happening after that. These are technically the highest correlated to current reads. So I think the important thing is here, we have two of the periods that are most similar to current data and current markets literally correlated in this matrix. Let's move over now to recessions. Now, I shared over on Twitter, follow at FX Evolution if you're interested, this particular chart. This goes through over 100 years of data and basically says, well, have we ever seen recessions? And it actually pulls back even further in year 3 of a presidential cycle. So remember, we've gone past year 1. That seems to be the most prevalent. We've gone past year 2. We're now in year 3, which is 2023. And we're not quite in year 4, but year 4 seems to be the second largest read for recessions. Now, if we think about what the bonds market's been telling us, that is something that we've seen before. We know that the bonds are heavily yield inverted. That means that over 50% of all the yields are inverted. And today, I want to show you usually when you'll know recessions are coming. At the moment, we cannot call it just yet. We haven't seen unemployment, of course, spike, and that means that usually you're at least over 6 months away. I want to just remind everybody, we usually do a couple of giveaways a year. We are about to do one here, which is of course for our courses. It's completely free to enter. Links in the description down below if you're interested. We'll talk about it some more in subsequent videos. So we've been bringing up this idea of Federal Reserve liquidity or central bank liquidity in the world. Now we know at the moment the Fed is basically tapering. They say don't fight the Fed. And there are certain periods where you want to fight it and when you don't. But if you think about it, since we really started all of this asset purchasing back in the GFC, the global financial crisis over here, mostly markets have been on a tear. Now, there is a period of time, especially from 2018 to 2020, where markets went up while the Federal Reserve was tapering. What's the big difference? In my opinion, it's interest rates. We saw a cutting of interest rates during that period of time, as well as a tapering of assets. So it kind of counteracted each other, and we ended up seeing a kangarooing style overall growth market. This time, however, we have higher interest rates for longer, which we'll be getting into a discussion for. And of course, we continue to see the Fed taper at an accelerated or at a steady pace. Now, there are some other things with global liquidity when we consider the Fed, the ECB, the repo market, the Bank of China, People's Bank of Canada, Bank of England, etc., that have risen this market up. So basically, we've seen some relaxing of liquidity. And a lot of that has to do with supporting, in my belief, zombie companies. If you actually have a look through a lot of exchanges, let me know what you think in the comments down below. Zombie companies are kind of everywhere in the world right now, and most of them have been propped up by central banks around the world. So what's the market doing? Well, the market is currently pricing in most likely that 95-day bull market and the idea of course, non-recession. So we're following that no recession path. Now, the bonds market disagrees with that, but of course, it's a question of timing. We also know, if you're new to this channel, the Fed tends to break something when they do tightening. Here's our tightening curve right now, which is getting worse. And we know that when they pivot, that means they've broken something and they're coming into support. Here's what happens when Fed pivots. Stocks generally crash by a pretty significant margin. Now, in some cases, it wasn't that bad. 4.4% here off the 80s. But if you notice some of the correlated periods of time, the early 80s, the 70s, similar inflation periods, we have some pretty bad Fed pivoting scores. So if we do continue to rally, which we'll be talking about later on in our S&P 500 analysis, and we do have the expected moves, don't worry guys, they're on the charts for today, then we could be looking at still some significant declines later on. So one of our base cases for, of course, February, middle to March was that markets would dip. So we did end up dipping around the 15th. We actually also saw liquidity start to kind of like struggle around that period, which was interesting. And we saw consumer sentiment survey reports come in incredibly bullish. That is now switched to being bearish again. So consumer sentiment is now bearish as we're around this level. So does it have to follow this path exactly? The answer is no. Of course, you might be hoping for March to have that kind of glut sell-off that's had before, but the data is partially skewed by, of course, things like the COVID pandemic, 2020, that type of thing. So generally speaking, we usually see kangaroo or kind of struggling market up until around that 15th of March, and then we often see the rally. Now, will the rally happen again? Well, we'll look at the charts a little bit later on. We know the volatility tends to spike over that period as well, but these 0 DTE or ODTE options are basically ruining the VIX right now. So, of course, you generally see volatility spike. And we also have, I would say, a neutralization of the market. So if I'm looking at money inflows at the moment, whether you want to consider it smart money or dumb money, the market is happy to be positioned where it is. It believes it's kind of stuck between 2 points. Are we going into a new bull market and there's no recession? Or are things about to get worse? The market is on the precipice of both sides, and 4K is basically the fight zone for this. If you actually have a look at the most touched and most traded zone throughout pretty much the last 12 months, even longer, 4,000 or just underneath 4,000 is the most traded volume zone. So clearly we would call this equilibrium on the charts. And I think it's really important to know that actually not many people have any idea, and we can see this in economic reports. Remember, there is a 42% spread between the low and the high economists right now on what they expect is going to happen this year. There is absolute confusion out there. So you may be better off focusing on the short date until things become a little bit more clear. Now, federal funds rates higher for longer. The bonds market seems to have a clear picture of what's going on. And basically that's a recession and that interest rates are going to have to stay higher for longer, which is really going to start to put pressure on earnings. Remember, at the moment, we haven't seen these interest rates for a very long time in the markets. The Fed's kind of gone like this. Yes, we're going to raise rates like vertically off a cliff. So that hasn't really hit the American consumer yet as much as you would expect. We can see it. People are spending on credit cards. We've brought up that data before. So what this shows us is that the Federal Reserve terminal rate is going to hit at this point, according to the bonds market, 5.5%. Some people believe it's 6%. I'll be putting out a survey today. Make sure to vote on it on the YouTube. We'll find out what you guys think, whether it's 6, 7, or 5.5%. And then they'll cut, but they're not going to cut to the low rates that were expected. Back last year, even as early as 2023 in January here, they actually expected rates to go back to 3%. Now we're expecting rates to go to 4% as of the time of this recording, and that's by 2025. So imagine what that could do to real estate. Imagine what that could do to these zombie companies. Some zombie companies will die without the Federal Reserve coming back in to support them. And that's going to be probably the storyline, I believe, of the next 6 months to 12 months. Zombie companies. What is happening? Bankruptcies should start to come through from some of these that are starting to struggle. Now, what have we got going on in the markets? I brought up utilities last week for a reason. Utilities tends to have a good little period at this time, and it was a very hated sector of the market, almost completely oversold to a point where people were getting blitzed by it. And then all of a sudden it did a switch only a few days ago. Now, on the Monday trade, utilities actually kept up with technology. If you watch our live stream, that's actually what I suspected may occur. And here's the switch in utilities. Look at this. Utilities goes from being absolutely horrible, over 3 and a bit% down, to suddenly being back in the positive. And yes, okay, it's still in one of the worst performing sectors, but that could be like a bit of capitulation selling into a defensive pick. We want to see if the market stays high, defensives start to get rotated into. Basically, that hasn't happened, which makes you think the bulls could be around at this stage. Usually, Wall Street will defensively back their positions by going into things like staples, utilities, and healthcare before they actually crunch a market heavily. That's one of the signs that we have not seen for quite some period. So just before we jump into the charts, I wanted to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Here is one of the new application features. It's called Portfolio Insights. You can go to the homepage, click on Portfolio, click on your watch list, and see all of the information coming out about specific stocks that you have in your watch list or in your portfolio. You can also go down to the community tab, which is the new initiative that Tiger Brokers has. And you can see here there are articles about all of your hottest stocks, about some of the ones that are your favorites, because of course it's customized to you. And more importantly, they have some excellent fundamental data, graphs, and charts. So if you're interested in finding out more about Tiger Brokers, why not check them out? Links in the description down below. And of course, for our Australian and New Zealand audience out there, there's some extra special little offers. We've partnered with Tiger Brokers to bring you some additional fractional shares. Check them out. What are you waiting for? All right, let's have a look now into the stocks themselves and let's look into these charts. We'll start off here with one of my favorites at the moment, which is of course TLT Treasuries. TLT Treasuries is a place that tends to be good when people believe that either they suck, which they don't right now, or they need them. So eventually assets will be required for fund managers and also financial advisors and everybody else where they'll say, oh, we think a recession's coming again, and they generally will jump into treasuries. Now, we saw kind of like monetary flow start to come through to treasuries around here of 2022. So that was really around that period of kind of June into August. Then, of course, we got that final or that big sell-off that occurred here. And since then, we've kind of traded within a range. And we thought that this was a pretty good area, which we met only a week ago. Now, treasuries is not a trade, really. What it is it's more of an investment philosophy. If you believe a recession is coming, that tends to be an interesting period for treasuries because they tend to do well during recessions and they tend to do well during, of course, periods when people hate them, which tends to be end of cycle periods. You know, if you've ever heard of the business cycle before, that kind of 8 to 10 year period, that tends to be when TLT does well. Again, back in 2018, you can see it on the chart. So if you go back over here, there's 2018, everybody hated them, and all of a sudden they have a massive outperformance of everything else. So treasuries are at an interesting point. We saw some rejection buying. You can see here on the weekly, a very important wick that came through here. And I expect them to kind of hover while interest rates, of course, potentially go higher. And if the higher they go, the more treasuries will suffer. But once you see the Fed pivot, which eventually they will, then treasuries should theoretically perform okay, because it'll mean something is broken in the system. Remember, the Federal Reserve never pivots out of the goodness of their heart. We're also watching Dr. Copper at the moment to see whether copper or metals traders are feeling the economy is going to go weak. At the moment, we've seen the weakness come in, but we haven't seen the continuation new lows. Alerts under 3.93 is going to be a critical level. We'll continue to follow the story and bring it up here on the charts. Now, what about the US dollar? Well, it hit our critical 105.25 only a week ago. And since then, we've kind of been in, limbo land. I would say we're in consolidation on a lot of currencies. We hit critical zones on some things like the Aussie, and also we hit it on the euro and the pound and others. So effectively, the US dollar is in limbo land. Where are the buyers? You would think they're really strong around that 103.775. At the moment, you're kind of in the middle of nowhere land. There is a case to say that there is high risk style trading because of this break up here around these lows with stops underneath here that, push that dollar index kind of style. But as you might have seen, if you watched our videos last week, the data points to every single one of the major rallies coming through for US dollars theoretically being met by weakness due to the nature of the initial sell-off. So that's that sell-off that we saw late last year. this is kind of like a relief rally from that sell-off. So remember, this didn't happen for no reason. This happens because the market is probably predicting a Fed pivot at some time in the future, and it's weakening the US dollar due to that. Let's move over to gold. Gold is above that break of last week, 1847, a fairly significant level. Let's have a look at the weekly here. Closed on its high, makes you think that the next level could be 1870, which of course, if the US dollar does weaken, gold should theoretically come back into here. And this doesn't mean that's the beginning of a new gold run. Gold tends to do well when yields are cut. And at this point, everything's looked bad for gold because, of course, interest rates have been going up, not down. Non-farm payrolls, which happens at the end of this week, the unemployment numbers, could be a massive deciding factor for gold. And remember, I am bullish on gold. You know, if you were to say to me, what do you think is going to happen to gold over the next 5 years? I'd probably say gold's going to $3,000 an ounce. Now, what are your predictions? Put them in the comments down below. That's my opinion, and I don't think it's insane. I just think you need to see rate cuts. And until you get that, it's going to be very, very difficult for gold to actually see those appreciation goals. It's actually been held back for a long time, gold. It's kind of like manipulated down like silver. So gold theoretically should be at $3,000 or $4,000 an ounce by now. It's being bought by a lot of central banks around the world. I do think it's the original currency, and I see it as being okay in a time of cut rates, which we haven't seen yet. Now, the Widowmaker, here we go. Natural gas, it lives up to its name. Everybody's talking about this. Unfortunately, people probably got whipped by it over the weekend. This is the nature of futures contracts. If we take from the high to the lows, this is the close of the Friday to where it got to yesterday, it was down as much as 15%. Some of the ETFs that people trade were down even more. Remember, ETF does not mean security, guys. They generally search the exchange traded fund, let's say it's BOIL, search BOIL fact sheet, and what you'll notice is that it is actually futures contracts generally behind, okay? So just be careful on ETFs. This is called the Widowmaker for the reason. Now, where do I think the market's going to? Well, I kind of have this 2447 in mind. I'd like to see natural gas fall back down, come into this structure, and potentially find buyers again. This is a dangerous, dangerous position. You have to be willing to literally feel 20 to 30% moves and being able to absorb that kind of thing. I could still see the market even bottoming off. Remember, the scenarios of a bottom are kind of like this as the most aggressive style bottoming effect. There's also this kind of thing, which is more of a Wyckoff kind of build accumulation. And if you do think it's a Wyckoff, you want to see volumes remain quite high. So time will tell. We'll continue to follow it. Natural gas, super exciting right now. To put in perspective, this is the drop off, so I can see why people are speculating. We got the similar roll to last time, but even here, notice it came back down to actually this zone, interestingly enough, and then found rallies. And it took a little while to base off. It's not usually an instantaneous thing. People get used to so fast whipsaw reactions. To stop the freight train down can take some time. So at the moment, natural gas, we're kind of expecting a little bit lower. Speaking of freight trains, here's a freight train. That's Tesla. So Tesla had actually a pretty bad session. Now, it's probably in line with something that most people call me a hater for. And yeah, I mean, I definitely, look, I have a Tesla. I do like the cars. But overall, I just find this an egregious gap that I think should be closed at some point. Now, is this a Wyckoff distribution? Well, take a look at the weekly expected highs and lows. It's the top of the range and the bottom of the range. I think that's pretty funny. Remember, this should hold the market 68% of the time, and it's literally sitting on both edges in terms of expected options ranges. We have the buyer's climax, we have a sell-off, we have the rally, we have a UT style position, which Wyckoff states. And what you want to do in these situations is you want to add volume to your charts because volume becomes important. Now, people are saying, well, Tom, the volume's dropping. Yeah, but Wyckoff's third law of effort was basically if you had a sustained run in either direction and during the period of distribution or accumulation, you had increased volume, that is, volume was consistent and actually quite high, higher than the norm, which is over here, then that could show you that the composite man, or in this case, Wall Street, was selling positions into retail. At this stage, with the evidence that we have, market doesn't look good for Tesla. You've got that really high level. You've got the island reversal back end. You've obviously seen the reaction of the Monday trade. And I kind of feel like it's going to do its own thing. Ultimately, it will come with the market. But if I was looking at this, I would say caution, caution, caution at this stage. Let's move over to Tesla on the options sides. So some people obviously are starting to agree with that because they're selling they're buying 190 puts. This is all like tons of puts all over this particular strike. So we've got 190 puts on the bottom end, which if you look back over to Tesla, really brings you back down to these 186s. So you'd have to say that's maybe a put wall. And you've still got a lot of calls coming through at 200, 205, 210. Let's look forward to the 17th because this is the major OPEX. This is the major options expiration. Again, a little bit more calls on the 200 strike, a lot of puts all the way through the market. The maximum pain level is 183.33. So that's actually lower than the current price. Will the markets end up trying to go for max pain during the third week options expiration? I think at the moment we need to be following as well very much the daily changes in these options because Wall Street doesn't have the liquidity. Look for tomorrow's video, the video I'll do at the end of Tuesday's session on my thoughts on ODTEs because I believe that they've got a big problem and I think that it's going to need to be regulated. So we'll talk about that more in that video. Okay, here's one that's coming out of the gates flying and it hit into the supply. So this is where we've seen selling occur time and time and time again for Apple. Another rejection candle coming through here. Apple had 3 incredibly strong days. Big gap, big gap. We've got the expected weekly options highs and lows. And guess what? It slammed straight into the high option expectation immediately. That was on the open. Literally, it came in, rallied up, found this supply again, and shorted off. Now, we've got some big gap closes, so I think day traders will like to see follow-through lows here. If that occurs, maybe move down to this fill. So Apple's getting exciting again, 151.13, which is the previous week close. And then, of course, we've got a gap down all the way back down here, which is 145.94. So Apple comes out very, very strong here, but probably a little bit fast. Big knee-jerk reaction, lots of gaps left behind, and sells the supply. Nvidia, again, kind of weak session for it. I wouldn't fight with this thing right now. We obviously had this incredibly critical level previously. If you do fight with this market, then you're fighting with it with the idea that this may be consolidation. So let's say the market then comes down, kind of hits this low and then gaps below. If that happens, then you'll have your island reversal style trade. You'll have that breakout, which would have done a stop loss hunt over the top of a lot of people's stop losses. You've got still elevated volume. And the way to do it is going to probably be an option because you've got to be really careful. We still have this unfilled gap up here at 259. Remember, the word AI is very strong. The more the company mentions it, the more it could create ferocious moves. And as far as kind of like unrealistic rallies go, we've seen these happen before on stocks like Nvidia. We've seen it happen on Moderna. We've seen it happen on GameStop, on AMC, lots and lots of markets. Let's move over to the indices now. We'll start off with the world index, which is, of course, the Australian market where I'm from. We've got here the trend line that is holding the market at the moment. I still think the Australian market's going to come into some problems, and I still expect it to find further weakness down. But this is a nice little bounce off the trend line, and realistically, that's the main thing that's holding this market up at this stage. If copper weakens, expect this market to really get hit. Let's move over to the indices. We'll go here actually to a sector first. So we'll go to the utility sector in America. Notice that huge sell-off that occurred, that gap on gap, kind of similar to Apple, but in reverse, gap down, swings a whole bunch, volume starts increasing out of nowhere, and then all of a sudden it goes bam. So yeah, utilities certainly starting to heat up. I'd like to see utilities beating out the other sectors over the next week to 2 weeks of trading. Let's find out whether it can do so. Let's move over to Qs. So good news on the Qs, if you're a bear. That's a shooting star. So it's nice to see that. More importantly, look at what it did. It filled both of the gaps that were left behind on the Qs. So the Qs filled both gaps. And when we put this in the context of the monthly candle, it kind of just looks like a standard retracement, doesn't it? So let's actually look at the retracement size. We'll go back to the 2-hour chart. We'll go from the high to the low. Let's actually pull that out. So if we pull the high to the low, well, lo and behold, we come back to that pocket. So we come back to the pocket and we've found weakness after getting that huge rally. We can see the options expected highs and lows. Notice the low is also on the unfilled gap that was left over here from last week's trade. And that's a nice, big, long rally. I mean, that's a huge rally with no pullbacks in it. So, of course, now we've seen one little sign of weakness. How is this going to turn? Well, I think the SPX is going to give us the most amount of information. Here's the futures, just so you can see it. And then we'll move over to the SPX itself. So this one didn't fill both gaps. 40.7907. The high for the day, 40.78.49. It didn't quite get there. So what if the market was to do this? And then it broke down below. I would say down we go at least to here. Probably see a reaction there towards the bull side. And then we make the choice whether we're actually going to go rallying to a serious level. Like I'm talking like 4,300, 4,350. I think what happens here is going to be really important for this market. Or do we go down to the 3,750, 3,800 zone, which is one of the most traded levels for quite some time? Well, we're probably going to find out maybe as of the jobs number. So remember, at the moment, people will have shorts with stop losses above here. If the market swings that, fills the gap, then drops, what's it done? It's hunted those stop losses. You've got to be prepared for all scenarios. And at the moment, on the surface of things, it looks like it's trying to reject, but we don't quite have enough information for it. Keep your unfilled gaps in. Make sure you've got them all on the charts. Here are the expected weekly options highs and lows, so you've got them there. Let's go over to the futures market, though, because what this did was it tapped into, of course, this supply, which is in the bottom of our box area, and then it sold off fairly aggressively. Now, if you take the range, so you take the low to the current high, and you think about if this market ends up selling off here and coming back down, we have a high, low, lower low, higher high, and we'd be pulling back into that without filling properly that 40.79 and 40.90 gap. That most likely would call for bulls to be buying in at 39.81. So at the moment, the market's setting up with a literal fib confluence on the gap fill, on the weekly low, or the weekly close, and kind of pointing towards, okay, well, we didn't fill these. If you're a bear, what you actually want this market to do is this. You really want it to take those two fill gaps, then reject, and show you that it means business in terms of actually trapping and selling down. That hasn't happened at this stage. So where's the critical level for us to watch over the next 24 hours? Well, first up, we want to have alerts above the new high. Get a new high, see how it interacts with the fill zones. Pretty important. If the market then starts to come down, where are some of our critical levels? So I think something like 40.37 is going to be fairly key, because 40.37, we know it's a low once, we know it's tapped it, and then it's come back down. So it's kind of like a little demand zone. If that gets breached, pullback should be met by sell demand that pushes the 39.81. So these are the short date narratives here for the market moving forward. Now, what's the data telling us? Kangaroo-y drop, potential weakness around this period of March, and then potentially some nice strength coming into the back of March into April. Well, again, depends on the sectors that are starting to fire. We've got a lot of information there. We also have big options expiration coming up. 395 for this week is the big put level. So we've got calls at 400, calls at 405, calls at 410. Maximum pain is 400, although I wouldn't use it this week. But let's go forward to the 17th. So the 17th, it goes from 1 million something units to 4.8 million units. Now, this is where the bulls probably feel a little bit more confident. Take a look at some of these strike levels. 390 puts, 395 puts, and 400 puts. We've said this here since the 15th of February. The only time the market really had to potentially bust low, easily that is, was between the 15th of Feb and the 17th of March. Because we have too many puts. There's still so many leftover puts on these these third week options expirations. So again, even if the market dips here, are we now starting to see bull case? Probably. And I think it's pretty likely that the market will try to come back for the 39.81. What do you guys think? The 39.81 gap fill seems like it probably wants to do it. And if it does do it without filling these two that are here, I think it strengthens bull case scenarios towards the upside. And remember, if Wall Street picks this up, it's pretty close to where you were actually on the lows. And there are some stocks, if you can believe it, that are relatively, cheap in comparison to other things. I mean, have a look at this. If you actually load up a chart and you put Amazon versus the Qs, and then you put that on a chart and you look at this in history, in context, Amazon is the same price as it was relative to the Nasdaq as 2016. So it's pretty, as a ratio, I put this on the live stream last night. That is pretty amazing how badly performing Amazon is versus the Qs at this stage. Let's now move over to the final thing that we cover here, which is Bitcoin before the news. And of course, with Bitcoin, well, you can see on the charts, it is absolutely doing nothing. It had that scare, which sold a lot. We're not at any of our watch reaction zones. We know that the market has overall been bullish recently. We expected bears to come here. They committed. If that is closed above, remember next level is 30K. And if we get underneath these two zones, specifically that white zone, I think the market could melt in Bitcoin. So you've got to be really careful underneath here. For buyers, you're hoping buyers recommit in this area. For sellers, you're just basically looking at how it interacts with things like the 23,500 at this stage. If it does rally, are there sellers there? That's what you're going to be looking at for Bitcoin. Probably stuck in between two zones. For the market ahead, we've got Powell coming out to annoy us many days of the week. He's coming 10 a.m. Tuesday, March the 7th. Then we scroll down here. We've also got him coming 10 a.m. on Wednesday. Yay for Powell. Jolt's job openings. And then if we scroll down further, we have non-farm employment change at 8:30 a.m. This is the big one to see whether a recession could be in. Remember, jobs numbers, or in this case, unemployment, tends to rise around 6 months before a recession on average. So we haven't even seen that yet. If it does tend to rise, then we can start to at least make some assumptions. But unfortunately for bears out there at the moment, for big bears, the ones that really want the market to crash, it's going to be difficult for it to do it at this stage with the amount of puts that are still in the system. The market has positioned itself as neutral. If you haven't already, come and follow us over at FX Evolution on the socials. We've got 3 free trading cheat sheets as well. And remember, our data report's coming very soon. If you sign up for this, I'll send you the data report when it's through. You can also follow us on the other socials. And do remember as well, a sponsor of today's video, which is Tiger Brokers. Check them out. Links in the description down below as well. Subscribe, smash the like button if you enjoyed the content. We'll see you in the next one. Thanks so much for watching. Bye for now.